Hey everyone, welcome to this explainer. I am absolutely thrilled to have you here today. If you're looking to buy a home around the Richmond or Henrico area, you've probably seen those flashy ads popping up on your screen. Zero down payment, 100% financing. I mean, it sounds like an absolute dream, especially in today's wild housing market. The USDA Home Loan Program is usually the vehicle behind those huge promises. But today, our goal is to completely demystify that zero down promise. We are going to separate the marketing hype from the ground-level financial reality of buying a home in Central Virginia, using insights directly from local mortgage expert Duane Buziak.
Okay, let's dive right into this. Anyone can read a glossy brochure, but when it comes down to your personal finances, well, that brochure doesn't write the monthly check. We have to look at the actual payment, the true fee structure, and the incredibly strict property eligibility requirements. The stark contrast between the marketing allure of zero down and the financial reality of actually closing on a house is exactly what we're going to unpack today.
So here's our roadmap for today. We're going to start by unpacking that zero down promise, then we'll look at the real Richmond market numbers, compare USDA against other loans, uncover some common qualification traps, and finally, wrap things up with a practical 5-step roadmap.
Section 1. The Zero Down Promise. Unpacking the math behind 0% down.
Let's put some real numbers to this to see how it works. Imagine you're buying a $325,000 home with a 6.5% interest rate. With the USDA loan, you put zero down, and your principal and interest payment lands at roughly $2,054 a month. But wait, let's compare that to a conventional loan on that exact same house where you put just 3% down. Because you actually put a little money down, your loan amount drops to $315,250, plus you'll have mortgage insurance. When the dust finally settles, the monthly gap between these two options, it's only about $140. Now, $140 a month might not sound like a total game changer right away, but over 5 years, we're talking about roughly $8,400 out of your pocket. And that's before we even factor in tax treatments or extra principal payments. So sure, zero down keeps your cash in the bank today, but it definitely carries a long-term cost.
And speaking of costs, we really need to completely shatter the myth that zero down means zero cost. It doesn't. The USDA program has what we could honestly call hidden costs. First off, there is a 1% upfront guarantee fee. Usually, this just gets financed directly into your loan amount, which means, you are paying interest on it for decades. Second, there's a 0.35% annual fee, which is chopped up and paid monthly right alongside your mortgage. And finally, and this is a really big one, you still have closing costs. In Virginia, closing costs commonly range from 2% to 4% of the purchase price, depending on taxes, title charges, and escrows. So even with a zero down loan, buyers absolutely need to prepare financially to bring some cash to the table, unless you've somehow managed to negotiate a stellar seller credit.
Moving on to Section 2. Real Richmond market numbers. Matching the loan to the local geography.
So the USDA loan is fundamentally a rural and suburban development program. It is fiercely tied to geography. It's almost like a giant puzzle. This loan works exceptionally well if you're looking out in Western Henrico, the areas just outside that highly built-up short pump core, or the more rural stretches way beyond the city limits. But where does it absolutely fail? The city of Richmond proper. If you're dreaming of a gorgeous historic row house in the Fan, a spot in the Museum District, or literally any dense in-town neighborhood, you just have to cross USDA off your list right now. The geographic eligibility rules simply won't allow it.
Now, what's really interesting here is how local numbers actually dictate buyer behavior. The median sold price in Henrico County is currently hovering right around $410,000. Because the lower-priced inventory is so incredibly competitive, this median price actively pushes USDA buyers further out into those eligible zones just so they can find affordability. On the flip side, the conforming loan limit in Central Virginia is a massive $806,500. That tells us that most buyers around here aren't jumping into jumbo loans. Their purchases are staying conforming. So the true heavyweight battle for a buyer isn't USDA versus jumbo, it's actually USDA versus conventional.
All right, Section 3. USDA versus other loans. The side-by-side battle.
You can kind of think of each of these loans as having a specific superpower, but also some serious kryptonite. USDA is the absolute undisputed champion of the down payment at 0%, right? Compare that to FHA's 3.5% and conventional's 3 to 5%. But look at the trade-offs. USDA comes with strict area limits and income limits. Those are restrictions that FHA and conventional simply do not have. And when we talk about credit flexibility, USDA is, well, just moderate. Lenders often prefer a 640 score for a smooth process. If your credit is a little bruised, FHA is much stronger and way more forgiving. But if your credit is excellent, conventional is going to give you the absolute best pricing. Plus, think about it from the seller's perspective. In a multiple offer situation in a hot Henrico school zone, a conventional loan with strong cash reserves just looks much simpler and more appealing to a seller than a USDA loan with all its extra bureaucratic rules.
Let's dive into Section 4, Common Qualification Traps. This is where buyers usually get tripped up.
Think about this for a second. Does an affordable home automatically mean it's USDA eligible? The answer is a definitive, flat-out no. Honestly, this is the single most common mistake buyers make. A home could be incredibly affordable, practically perfectly priced for a first-time buyer, but if it sits on the wrong side of that invisible USDA eligibility map line, the loan will be denied, no exceptions. Price alone does not dictate eligibility. Location is king.
So the absolutely crucial point we need to make here is understanding household income limits. Notice I said household, not borrower income limits. The USDA actually looks at the income of all adult household members to determine if you're under their program limits. Say you apply for the loan based entirely on your personal salary, and boom, you easily qualify. Great, right? Well, actually, if your partner, who isn't even going to be on the mortgage note, also earns an income and is going to live in the house, the USDA takes their income and adds it to yours for eligibility. That second income can instantly push your household over the limit and completely blow up the qualification math. Let me tell you, this catches so many buyers entirely off guard.
And there are 3 more hurdles you've got to clear. First up, property condition. The USDA program is not for fixer-uppers at all. The home has to meet basic safety, soundness, and livability standards. If a house has obvious deferred maintenance, say a failing roof, you're probably going to need to pivot and look at an FHA 203K or a conventional renovation loan instead. Second, occupancy. You actually have to live there, so no investors, no rental properties, no second homes. And third, while exceptions do occasionally exist, a credit score of 640 is highly preferred by lenders if you want to get a smooth, automated approval right through the system.
Which brings us to Section 5, the 5-step roadmap. This is your pragmatic playbook.
Let's move to the actionable stuff and see how this actually builds your strategy for success. Step 1. Start with a soft pull pre-qualification. Find out your debt ratios and your likely eligibility without taking a hit to your credit score from a hard inquiry. Step 2. Check that USDA eligibility map immediately. Seriously, do not fall in love with a house until you verify the address actually fits on the map. Step 3. Review your total household income, remembering to include every single earning adult who will be living there. Step 4. Run the math. Have your lender compare USDA side-by-side with FHA and a 3% conventional loan, making sure they use the exact same purchase price and taxes. And finally, Step 5. Get fully documented early. In a fast-moving, highly competitive market like Richmond and Henrico, your speed matters almost as much as your interest rate. Having your paperwork perfectly pristine, that puts you right at the front of the line.
I want to leave you with this final provocative thought. Are you just chasing a headline rate, or are you actually matching the loan to your market reality? The absolute smartest move you can make isn't blindly chasing zero down. It's aligning your financing to the exact property you want, your true household income structure, and the actual speed of the local market you're bidding in. That is exactly how you win in real estate. Thank you so much for joining me on this explainer. Keep learning, keep analyzing those numbers, and we'll catch you next time.